And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis, and Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I'm doing awesome. How are you doing?
It's great to see you. I am doing awesome too. Thank you so much for asking. And I know that things have been obviously incredibly busy for you. We talk about that every week that we're together, but every time I see you, it's getting busier and busier.
Oh my goodness.
How are you balancing it all?
Yeah, I'm trying. I'm just, I'm down to 6 days a week working now. So we're busier than we know what to do with. Judd as well is swamped. We're trying to hold our heads above water here.
Sure.
It's just because the response has been so great.
Absolutely. Well, what sets you apart, because you are so focused on tax planning. And we've talked about this in the past, that a lot of people are kind of trying to do a copycat, if you will, because they see that you're so passionate about it. And you've developed that, obviously. So why are people so concerned with taxes, Stewart? What's going on?
Well, I think people realize that we are in the most efficient tax window in history right now. And I think we have a graphic that, if we can pull that up, it's about taxes. And what these tax brackets will show you is how efficient we actually are right now. If you take a look at the blue, that is the 2017 tax rates. That's before Trump was elected. The red is showing the Trump tax cuts. And I think a lot of people believe in the back of their mind that the tax cuts only benefited the wealthy. But what we're showing you here is that when you also look at the standard deduction, if you see that 0% bracket at the bottom there, there's a big dollar amount that was expanded where people aren't paying taxes on that amount. And that is the standard deduction. If you take a look, a lot of our clients fall between the 22 and 24% tax brackets in red under the current one. Look at what they used to pay. The 22 used to be 25. The 24 used to be 28 up to 35%. We are in the most efficient tax window in history right now. It's super important, Cynthia, to realize that if your financial advisor isn't making plans according to our tax brackets today and what's available today, you are missing out. I am telling you today, if you don't have a tax plan, you could be paying exponentially more taxes for the rest of your life by not acting this year.
Let's talk a little bit about that, because a lot of people assume that once they hit retirement, their taxes are going to go down, but that's not always the case, correct?
No, I mean, oftentimes people will remain at the same bracket or actually increase in brackets, because remember, when you're working, people have kids, they have all of these deductions, and when you're retired, hopefully the kids move out. I hope mine do for sure, but you start missing out on a lot of those deductions. Your expenses are down, your house gets closer to being paid off, or it's paid off. And so a lot of those deductions that you once had to itemize with are no longer there. And what you have to consider the most is not just the income tax that you're going to pay on these investments, but also the income tax that you're going to pay on Social Security potentially. Because remember, when Social Security was created, it was never meant to be taxed. Franklin Delano Roosevelt said that Social Security would never be a revenue source for taxation. But believe it or not, it was Ronald Reagan that made it taxable for the first time in 1983. And then Bill Clinton made it more taxable. So oftentimes people will have $1 million saved for retirement, which I think is great. But they don't realize, they're so focused on this money, they're not realizing Social Security. Over a couple's life expectancy, they can receive between $900,000 and $1.8 million in benefit. So everyone is focused on the money side of it. You know why? Because that's how your advisor gets paid. They get paid off the money. They do the least amount of work necessary, Cynthia, to get paid. And I'm telling you, the reason they don't look at your taxes, the reason they don't look at any of that stuff is because it makes it a lot easier for them. Our tax season occupies a third of our year. And we could use that third of our year to grow our business rather than filing for taxes. But you know what? it gives us so much better information to be able to look at somebody's tax return and then not only look at it, to manipulate it, to play out scenarios. Hey, what if we do this or do that for next year? And that's what our November and December are for, is our tax planning, to really think through what can we do? What scenarios can we do to better, create a more efficient outcome in retirement?
Stuart, as well as taxes, I want to talk to you a little bit about the stock market, because obviously the stock market has been doing so well for so long. What happens when it's not doing so well?
Well, I think most people sense that we're closer to the end of this market than we are to the beginning of it, right? I think that's a pretty fair statement. We don't think it's going to go on for another 12 years. And while we technically saw a correction back in March of last year that took us out of a bull market, most people see that as an extension of the 2009 bull market start. Now, listen, you need to make sure you have a plan. A lot of people are full throttle, very aggressive because they've been enjoying this market and it's really paid for them. But let me just tell you a little story about me learning to play craps. The first time I learned to play craps was with the original owner of our company, a guy named Paul Mumford, great guy. And we were at a hotel called Sam's Town, a casino. And it was so funny because, I had $1,000 and literally 2 hours later, my $1,000 turned into $10,000. And he's teaching me all these mathematical formulas, do this, play the come line, the pass line. My 1,000 turned into 10, and I was a little bit loud and obnoxious, kind of like I am on this TV show. But I was having a great time, right? That's what happens at craps tables. And I just said, you know what? This isn't going to be Sam's Town. This is going to be Stewart's Town by the end of the night, right? Well, guess what? By the end of the night, I'm reaching back into my pocket and adding more money to it because the odds are the odds. What goes up will come down. And just realize that you need to sometimes know when to cash your chips out, when to take less risk with it. If I would have just cashed that out, I would have had 10 grand in my pocket.
Wow.
This was, 15 years ago or so.
Yeah.
But, it was a great lesson that stuck with me to just say, you got to know when to hold them and know when to fold them. And we're getting close to that point where you need to start de-risking your assets.
Are a lot of people having questions, Stuart, about rebalancing a portfolio, if you will?
Sure. And so when it comes to this, rebalancing and de-levering your risk, a lot of people have historically just said, okay, well, as we get closer to retirements, like we see in these target date retirement plans, a lot of people have 2025 or 2020 target retirement plans. And what people realize is as they get closer to retirement, that investment moves closer to bonds, more bonds, less stocks. But you have to realize that not only are we in the highest stock market in history with the lowest tax rates in history, we're also in the lowest interest rate environment, right? So we have low taxes, high stock market, and low interest rates. That is the perfect storm for a correction. Because I have this slide here, and I want to show you an example of the Treasury note, the 10-year Treasury. And what this slide will show you is how low we are historically. Now, this slide here, if you look, it starts in the 70s, it gets into that super high peak in the 80s, and then for 35 years, the interest rates have fallen. Now, that's about that time, as those interest rates have fallen, that we really started investing in mutual funds away from individual bonds and individual stocks. And for 35 years, as those interest rates have fallen, bond portfolios have done really well because lower interest rates mean higher bond values, right? Now, what happens when the opposite occurs? Like, look at that example right there from the 70s to the 80s as interest rates spiked. That's when we saw bank failures and junk bond collapses and so forth. Now, look at where we are in the right. We're at the lowest environment in history.
Yeah.
It's really easy for the interest rates to go from 1.5% to 3%, right? So just understand that rising interest rates is really, really bad for bonds. And I think it's important to make sure you understand what kind of duration you have on your bonds, what kind of quality you have on your bonds. The longer the term bond you have, typically the more volatile it is when it comes to interest rate sensitivity.
Absolutely. Well, Stewart, thank you so much for shedding some light on that. I think it's the perfect time for us to open up the phone lines. Would you agree?
Absolutely.
All right. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. What you're calling in for today is a complimentary consultation with Stewart. Let him take a look at what you currently have in place for your retirement plan. Are you on the right path? And if not, wouldn't you want to know that today? He's offering this opportunity to the first 10 callers only. All you have to do is pick up the phone and call 833-652-7829. We have to take a very short commercial break, but when we come back, I have some viewer questions. One of those may be your own. Stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is co-founder of Asset Preservation Tax and Retirement Services. A wonderful show that we're having today, Stewart, and obviously talking about such important topics surrounding retirement. What I love is that through the weeks, we've had a lot of viewer questions come in, and so I'm really happy that we're going to take some time to address some of those. How do you feel about that?
Oh man, always a surprise. Let's do it.
Okay, this is a great one. Stewart, can you explain to me the difference between a will and a trust?
Sure. So a will is simply an expression of your wishes. What you want to have happen. It's a legal document that basically ensures that your wishes will be observed. The problem with a will is that it virtually guarantees on its own that you'll go through a probate process. Now, everybody's situation's different. There's different probate dollar amount thresholds. But if for the average Arizonan, if all you have is a will, it's very possible you're going to go through a probate process. And so to understand the difference, you want to understand what probate is. Now, probate is not some evil thing. It's just really expensive. It's basically the courts determining who gets your money. Now, the will is your argument to determine who gets your money and usually holds up, right? But you want to make sure you avoid the process. Probate is expensive because you have to hire attorneys, you have to pay court fees. And what if somebody disagrees with what that distribution should be? Listen, I hear all the time about these wonderful kids that their kids are wonderful, they don't care about money, they're going to be sweethearts. Let me just tell you, if you want to see the Jerry Springer show, just come to my office during an estate settlement. It's unbelievable. So listen, these sweetheart kids all of a sudden turn into animals, right? So that's why it's really important that you have a trust. What a trust does, even if you don't think of yourself as a Rockefeller, as wealthy, right? If you have enough assets, if you own a piece of property, a home, it makes sense to get a trust in most cases because it absolutely, when funded properly, will avoid any probate. And what it does is it also prevents any fights because most of them have what we call no contest clauses in them. And what that is basically it says if your kids argue, they get nothing. So it keeps your sweetheart kids as sweetheart kids and not fighting, because if they do fight, if they do challenge it, they've basically forfeited in some cases their claim to the benefit. So it really makes sure that you avoid probate. When we do estate planning for clients, we've actually started off as an estate planning firm where we offered estate plans to people that didn't have millions of dollars. At this point, we do estate plans for all of our financial clients. We're more than happy to suggest it to our clients. We've had the same relationship with the same attorney for 15 years. It's been awesome. But, I tell people jokingly, the reason we suggest a trust, which at this point I don't make a cent on, it's because I don't want to hang out with your kids in probate court, right? I'm a man of leisure. I want to, be able to hang out on vacation, not hang out with your kids in court. But, in all seriousness, get it done. It's going to save you tons of money.
Yeah, absolutely. Stewart, thank you so much. This is another really great question. Stewart, I enjoy watching your show. Thank you so much. Is it difficult to do a Roth conversion on an IRA?
So the actual conversion usually isn't very difficult. Where the magic occurs is basically the difficulty is determining, how much to convert, right? A lot of people know they need to have Roths, they need to convert to Roths, they just don't know how much and what are the pitfalls. Here's an example. I had a client that did it on his own before he was a client, and he was 68 years old, and he was receiving Medicare, of course, Social Security, and he did a Roth conversion, which he was allowed to do. The problem is he did too much of it. He jumped into the 32% tax bracket. He ended up paying tons of penalties on Medicare. So listen, you just don't want to willy-nilly guess at how much you convert. You need to make sure you talk with a tax professional. And that's why it's really, really crucial to deal with a financial advisor that has tax services directly with them. Because honestly, when most people go to their financial advisor and they say, look, I want to do a Roth conversion, should I do it? The advisor will say, well, you know what, you need to talk to your tax person about that. Because most of these big box firms aren't allowed to talk about taxes, right? And so people are seeking guidance from their advisor and they're not getting it. So then they go to their accountant and they say, hey, you know what, my advisor said that I should do a Roth conversion. How much should I do? He said, I don't know, you go talk to your advisor. Well, they never end up talking. And I think that's the one beauty of our company is that we do both sides. We do the taxes, we do the financial planning. And so the left hand knows what the right hand's doing. It's important to make sure you have a plan.
Thank you so much, Stewart. This is also a great question. It's tying right into taxes. Stewart, what is the #1 strategy anyone can use to lower taxes? #1 strategy.
Well, you know what? That's I would call that a trick question. And the reason I say that is because lowering taxes now may not actually make sense for you long term, right? So let's just say that we believe that, Congress is going to change the tax laws and tax rates are going to increase next year. Well, why would you delay taxes till next year when you can pay them today at a discount, right? So saving taxes today may not make sense, but I think saving for the future taxes and your lifetime amount of taxes really makes sense. And one strategy that you can use is by harvesting your gains, your capital gains. One of the tax changes that may be coming is an increase of capital gains from a highest tax rate of 20% to all the way up to 39.7 plus a 3% net investment income tax. So basically 43% in taxes on capital gains when you can get it done for 20% today. So a lot of people with these long-term capital appreciated assets like homes or stocks, it may make sense to actually have a plan in place to see what this tax plan looks like and harvest this year.
Stewart, I know that you have a special offer that you're going to present to the viewers at home. Let's talk about what that is and then reopen the phone lines.
Sure. Well, today, if you give us a call at 833-652-7829, what we would be glad to do is do a complimentary portfolio review. And in that portfolio review, what we'll do is we'll take a look at any hidden tax issues that we're concerned with, any fees, etc. Just give us a call, 833-652-7829. We'd be glad to look.
Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen, and that number is 833-652-7829. We know you have a lot of questions about tax planning, questions on how to plan your perfect retirement. Stewart has the answers for you. All you have to do is take advantage of that complimentary consultation by picking up the phone and calling 833-652-7829. Don't go anywhere. We have more viewer questions when we come back, and the next one could be yours. Stay tuned.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's co-founder of Asset Preservation Tax and Retirement Services. Stewart, a wonderful show, and I'm glad that we're actually taking the final two segments and devoting them to the viewer questions because people have been so patient waiting for you to answer. So thank you so much.
No problem.
This is a great question. It says, Stewart, I've recently heard the term dollar cost averaging used in the news. As an investor, how do I utilize this strategy and what are the benefits of dollar cost averaging?
Well, some of the benefits of dollar cost averaging is basically it's purchasing assets over time. So if let's say you have $100,000 you want to invest, what it's saying is, let's just say it's your dollar cost averaging over 5 months. You basically put $20,000 a year over 5 months rather than purchasing all at once. Now, there's a couple reasons for that, because what if the market goes up or it goes down? It basically makes sure that your basis isn't all the same, meaning, the underlying tax issue. It also spreads out the risk over that time. So rather than kind of using the poker analogy of going all in, you're just playing a few hands at a time.
Okay, Stewart, thank you so much. This is a great question too. Stewart, what is the best way for someone to diversify their risk and reduce volatility? The best way?
Well, I think that is about as important of a question as you could ask. Now, diversifying your risk historically has meant to make sure that all your investments all aren't in one place, right? So people will say, I'll have a little bit of bonds here, some stocks here, but even the underlying stocks you want to make sure aren't all invested in the same thing. So what our portfolio analysis does is it looks at how really diversified are you? And I think it's really important to make sure you are diversified. But at asset preservation, we take it a step further. What we look at is not only the diversification of your investments, but the diversification of the perspectives in your portfolio. And Cynthia, what I mean by that is that a lot of people will have an advisor that picks their funds for them. Okay. And let's flash back to last year, to March of last year, where the market drops, intensely, right? But one of our money managers only saw, a third of the loss of the market. The other one saw, about 2/3 of it. But the reality is you don't want to be completely focused on one perspective, because what if one of them gets it wrong? What if your advisor gets it wrong? If all you're doing is relying on their opinion of the market, you're betting your entire life savings, your entire life's work on their opinion. Let's even look at November of last year. What happened in November of 2020? The election, right? And listen, the world is divided right now. You know, your reality is determined by what news channel you watch oftentimes, right? So if you watch, you know, on cable news, is where we see the craziness of it. But if you watch one of the far right channels, you believe one thing. If you watch one of the far left channels, you believe something else. It's a crazy time. And so a lot of people believe that if Joe Biden got elected, that the market would crash because of higher taxes, higher regulation. Then others believe that if Trump won, that the market could crash because there could be riots in the street and, you know, massive insurrection. Well, guess what? Neither of those scenarios happened. I mean, Biden won, but the market took off because, you know, the stimulus, none of those negative things actually occurred yet. But we had one money manager that basically went defensive. They basically went into a defensive posture to say, hey, we can't tolerate any losses if this happens. And they were still up gross of fees 0.68% in November of last year. One of our other money managers, who's the biggest money manager in the world, actually hit the gas. They actually said, no, we believe Biden's going to win, and we're going to benefit from it because of all of these social programs and government spending. And guess what? They were right. So someone's right and someone's wrong. But if you bet everything on one perspective, you're making a massive mistake with your life savings. And listen, these are both amazing money managers. They're not going to get it right all the time. So if you are relying entirely on an advisor sitting across the desk from you, picking your funds for you, I just say it's a tremendous amount of risk.
Absolutely. Stuart, I think we have time for one more question. Stuart, what exactly is a retirement income gap?
So the retirement income gap is basically a cash flow scenario where you have less income coming in retirement and you need to make up for it. And how are you going to make up for it? Usually you're using your investments, but sometimes people don't have enough of their investments to do it, or they have a certain, you know, scenario that they've played out in their mind that just can't be done. So what we do with our portfolio analysis and our cash flow analysis is we take a look at what's the likelihood of success of actually reaching full income in retirement, or at least your expected income in retirement.
That makes sense.
Yeah.
Well, Stuart, we have about 1 minute and 20 seconds left of the show this week. Any final words of advice that you'd like to share with the viewers at home?
Yeah, absolutely. You listen, I have clients that come in all the time that say, we've been watching your show for weeks now. We were nervous to call. I'm telling you, I will sit down with you. Judd will sit down with you. Give us a call. Make the call. You have to get off the couch and give us a call at 833-652-7829. If you have over $200,000 of investable assets, we'd be more than happy to do an analysis for you to tell you what kind of risks you're taking, what kind of fees you're paying, and in my opinion, as important as anything else, what kind of taxes are you facing down the road? And are there more efficiencies we can put in place? Just give us a call. I'd be glad to help.
Stuart, I can't believe that we're almost to the end of another amazing show. Thank you for all of the information that you share with the viewers at home. I know that they appreciate it as well. To the viewers at home, most specifically, I want to thank you for spending time with us today. That number to call is 833-652-7829. We know you have a lot of questions about how to plan for your taxes, how to plan for retirement. Stuart has the answers for you. Don't miss the opportunity to take advantage of the complimentary consultation. Be safe, be happy, be blessed, and we'll see you back 1 week from today. Take care.